Hey, welcome back to Two Super Guys Red Sox. I'm Dylan.
And I'm Vinny. And today we're going to talk about a stock that Michael Burry has owned in the past multiple times. It kind of is the partner to our Walgreens video we did last week. We're going to get a little bit into the nitty gritty of what exactly is CVS Health and what the financials look like for them. We'll get to it. All right. So we did this video last week. This is the thumbnail. Did like very well actually. People are really interested in what's going on with Walgreens right now. The stock's down massively. A lot of people were talking, like you said, about how our comparison to Meta was ridiculous. But to
Yeah.
me, I'll compare companies because I'm looking at it from an investment opportunity basis. It doesn't
100%.
matter what they are in, right? It,
Yeah.
it could be selling tacos on the side of the road. If I can make money on it, I can make money on it.
Yeah. I mean, people were saying, how can you compare Walgreens to Meta? I agree. Meta is awesome and it has a much better moat. But if you look at like 10-year returns of Meta and Domino's, they're almost the same. It's very close. And I would
Yeah,
argue Domino's has zero moat. There's pizza everywhere. So
yeah,
it's not, is Walgreens as good as Meta? No, it's not. It's,
yeah,
is this value way too low for what you're getting, and would it be a good investment opportunity? Like, actually, another good example, when I did a video on Schwab, right? Because Schwab took that huge hit. They're up 50% from where I bought it, about 50 to 75. It outpaced the market. So it's a solid buy. Am I a huge Schwab guy? Not really. But when a stock is just too low for no reason, that's when you look, okay, should this be a
yeah,
buy? So like CVS, it could be a problem. Vinny did the research on this, not me. So I don't know yet. I'm yeah.
yeah,
But when you have a stock in a sector that is shit, like Walgreens, it brings the entire sector down. So
yeah. Yeah, that's true. I mean, as a sector headwind, there's a lot of issues here. This is just something I want to highlight here. All right, this is like a maximum duration stock chart I could get from the Yahoo of CVS Health. Right, and look at the current price levels and look at the prior times we were at those same price levels. You're talking about 2019, they were on the same $55, $60 per share, and then all the way back to 2013, 2014 was the first time they touched this value. This is a stock that effectively, if you look at it from that standpoint, hasn't gone anywhere for a decade.
yeah, that's not ideal. I
Yeah.
mean, unless you sold at 110, then
But
hats
what
off
can
to you.
happen sometimes is that the stock price has yet to catch up to the business fundamentals, hopefully improving. So that's what we're going to look at it through that eye or that lens to see if maybe that's the case that's going on here. And just to kind of remind you, this is from Burry's most recent 13F. He currently does not hold any CVS stock. He has owned it multiple times, but in the most recent quarter, he sold his entire position and closed it out. But
I
that doesn't mean he's totally going to be having like an eye on the stock and may open a position again in the future. Knowing him, he trades in and out of the same ticker multiple times.
I believe he lost money on this one
Yeah, yeah.
from when he bought,
He,
right?
he,
We looked at that.
yeah, he did.
Yeah.
He's actually held it before and made money. But I mean, it's hard to make money on a stock when the stock went down 28% year to date, all right? And when you have the backdrop of the entire market hitting like all-time highs. It's crazy.
Yeah, it's not good.
Dividend investors love this stock because look at this current yield, 4.7%. All right. And
Okay.
this is another like, crazy thing to think about is when you see a household name, all right, and look at this forward PE projection under 8. Like this is insane. It says dig more, all right? Dig more daddy. Like
Dig more daddy. Oh
dig more
man, I hope
daddy.
people
Yeah.
start calling you that. That'd be
Yeah.
great.
All right. So I got some kind of charts here from macro trends to kind of highlight like overall what's been going on with them for the last several years. Revenue, growth, pretty consistent. They did have like a little bit of an increase here. You're going to talk a little bit about some acquisitions they have made. That's definitely part of their strategy. Is not just their legacy pharmaceutical growth, but also growth by acquisition. All right. Gross profit took a nice jump up here, with the addition of some of those acquisitions, but they've maintained a pretty solid gross profit, growing over time. Right?
Okay.
Net income a little less so, very very spiky all over the map. Once again, it's hard to integrate these companies as they acquire them. You have to look at each acquisition as an independent deal of whether or not you would make it and would you make it for that price, which can definitely complicate your valuations of companies. Right? Shares outstanding. All right. Part of the acquisitions were funded through, shares, some share offerings, which is not something I love to see because personally, if your shares are undervalued, which when you have a company that stock price hasn't moved in a decade, it makes you a little suspicious that maybe these things are actually undervalued, right? You'd have to do an individual analysis on that point in time, but still, I don't love using my shares as funds. I'd much rather use cash if that's available to me. All right. But
Mm.
like since that acquisition, they have kind of started to buy back shares. So they are redeploying capital back towards shareholders through both dividends and share repurchases. That is indeed their preferred modus operandi, if you will.
I believe
So
someone's going to
PE,
ask this in the
with
comments.
that,
Would you prefer only dividends or only share buybacks?
I like share
If you have,
buybacks
yeah.
more. Yeah,
Okay.
that's just me. I'm not a dividend guy. I want to do a separate video on that at some point. But this is looking at the historical PE over time. So you see that for the most part, back in the early 2010s, hovering around 10. They had like a little slight increase, got kind of choppy with the acquisitions here, but there seems to be their baseline more than anything else, right? That's really where their PE hangs out. They have yet to be priced at a premium. When you're looking at the overall market being 20 PE is very reasonable, and some of the biggest name tech companies in the world are trading for like 40 plus PEs.
Right.
Um, Same thing for price to free cash flow. All right. They tend to hover in this kind of like high single digit territory for price to free cash flow. And they're pretty close to their historical average throughout this entire time period, which is crazy. All right. When you think of CVS Health, this is what you picture, right?
Yes.
Yeah, your corner drugstore. What if I told you that this is actually a better like picture of CVS overall?
CVS. Okay. Well, okay. So I'm in Durham, so I deal with CVS Caremark all the time. I will say,
Uh-huh.
whenever, if anyone's familiar with GoodRx, it's a great way to get cheaper medications. Walgreens sucks. It's just, at least in Arizona, it's twice the price all the time.
Yeah.
So I always
Okay.
direct towards CVS, Fry's, Mark Cuban's, whatever.
Yeah. Yeah. So there's a lot of other aspects to the CVS business than the retail pharmacy, right? Don't forget they own Aetna, which is one of the largest health insurance companies in the country. It's like number three after Blue Cross and United.
I did not
They
know
own
that.
them. All right. They
Yeah.
own Caremark, which is the pharmacy benefit manager. I want to say it's the largest pharmacy benefit manager in terms of the number of prescriptions per year that they process, which is pretty crazy. Signify Health, which is a in-home assessment company that does medical exams for seniors and other people that are incapable of going out and being properly examined. We should clarify here. I also work in medicine. Over 2 million visits a year, so it's a pretty large entity as far as that aspect. And then they recently acquired Oak Street Health, an all-cash deal. So at least they didn't burn shares for this one. Almost $11 billion, and this is a primary care provider. I can't remember exactly the scale of this operation, but not small, like an over $10 billion company. All right. So this is when we're looking at corporate level price to free cash flow per share. This scares the ever living crap out of me. Look at this trend over the last couple of years. They were hovering in these low teen range, and the price free cash flow per share on the trailing 12-month basis has just plummeted, down by 50% over the last couple of years.
Okay. Also,
Yeah,
I just looked it up for you. Oak Street Health, 170 centers, 21 states. So it's
yeah,
pretty big.
yeah. Very sizable acquisition. Now, I've read through the annual report, most recent one, and this is where you really have to do your due diligence. This is not like a simple analysis. Um, they had over 30 pages of risk factors listed. All right.
Okay.
That is by far and away the largest I think I've ever seen for a company, which is impressive.
Okay. All
Yeah.
right.
And the fact that they're making all these acquisitions and all these different lines of business within healthcare, even they call out the fact that we don't even know what we're going to exposing ourselves to now that we're diversifying across all the different aspects of medicine. And one thing I wanted to highlight from a kind of governmental risk standpoint here is the cost of pharmaceutical drugs have certainly been at front and center of politics in the United States for a little while. This is from this year. This is the top 10 or dirty 10 of the Biden administration's efforts towards reducing cost of medications in particular, which is working medicine. These are certainly medications that are sought after and are notoriously expensive. But it's not just a partisan thing where you're going to see Democrats say we have this upcoming election. This is something that's bipartisan. Both parties have really focused on seniors, healthcare for seniors, and reducing costs. So this is going to be a continued area of political risk for companies like CVS. All right. Just want
Nice.
to highlight that. As far as some of the other financial numbers, I want to go over here. All right. Are you familiar with current ratio at all? Have you ever come across this?
Mm-mm.
So think of it basically as bankruptcy risk. Right? This is
Oh,
telling you looking at
yes.
current assets versus current liabilities.
Yep.
Right? And ideally, you want this over 1.5, meaning that
Yep.
they have enough assets that even in a fire sale condition where they had to take 30% off the price, they could meet all their current liabilities. All
I
right.
did not realize that was called current ratio, but yes,
Current ratio,
popular
yeah.
metric.
Yeah. So CVS it has a pretty horrible current ratio, 0.81. All right. It's worse than 94% of the other companies within the healthcare industry, according to Google Focus. Not
Okay.
great. All right.
Not ideal.
However, this would be an interesting debate. CVS may also be in the too big to fail category. Yeah, they have a lot of governmental risk, but they're so large and so important to healthcare in the United States that I find it hard to believe that if they tried to, have a cash flow situation, that government entities wouldn't come to their assistance. This is
I
crazy.
think so. I'm not gonna lie. I'm completely ignorant to CVS. I did not know that they owned Aetna.
Yeah,
So Aetna's huge.
yeah,
So I would have to agree.
yeah.
Unfortunately, I hate that that exists. Anything that's too big to fail, I don't like that. But I would agree.
So yeah, so does this number matter? Yes. Does it matter as much as it would appear to? Probably less so. Is what I'm trying to get at with that. Um, Return on invested capital. All right, this is how good is CVS Health at employing their kind of money in terms of returning, or getting a return on that invested money back for shareholders. And 4.4 is pretty horrendous. Personally, like you look at companies that are in double digits would be ideal when you're looking at other industries, particularly tech. It's certainly much more achievable over there. So this makes me go, okay, is it a company that I absolutely love the way that they're investing and they're buying all these other entities? I don't know. You really have to buy the long-term vision of CVS becoming this, one-stop, gargantuan healthcare company that you can't avoid. It touches so many parts of your life, and it is in some parts. But will that return money to them? I don't know. They haven't been able to monetize it the way that a Google can, right, or Apple. So
Hmm.
when you look at the trail 12 months free cash flow, I love cash flow. That's really how I want to value the business. It's a $10.89 billion with a trailing 12 months. Mind you, like I said, this has come down significantly from where they were a couple of years ago. Um, they have $9.8 billion in cash, $3.3 billion in investments carried on their balance sheet as the most recent quarter. I don't adjust for working capital versus non-working capital. I just use the entire thing as a lump sum when I'm calculating my enterprise value. This is another scary thing with them. They have this $57 billion in debt sitting on the balance sheet. That's their market cap is like 75 billion. I figure exactly. You'd have to do the math here to figure that out, but you can all get it from CNBC. It's almost the equal, parts equity and debt as far as their ownership,
I
which is
don't quite
not
understand why their dividend is so high when they have that much long-term debt. I
yeah,
get that it can be attractive for some investors, but short-term gain, long-term pain,
yeah.
they should be paying that down and not doing
Exactly.
a
I
dividend.
am not a fan of these companies that leverage themselves and prioritize dividend payment and dividend growth over anything else. That's why I don't like dividends. I think it makes management be even more short-sighted than trying to buy back shares and invest internally. I don't like the capital allocation plan for CVS Health. Um, but as far as when we get to the numbers meeting the road here, right? So $115 billion enterprise value, and based upon the trailing 12 months, that'd be a 9.4% free cash flow yield. Okay? So is that good? Yes. Um, is that great? No. I mean, we love Chinese equities here, and we're talking about many Chinese equities having 20, 25, sometimes 40% trailing 12 months like free cash flow yield. And when we talk about like major American tech stocks, yeah, 2.5 to 5% would be a pretty attractive free cash flow yield there, probably closer to five. And this is certainly above that. But there's a lot of questions here that you would have to be able to answer. One, I implore you to read those 30 pages of risk to the business. Two, I want you to kind of basically, I would think about what their long-term vision is here regarding healthcare and whether or not that's something that they can actually achieve. We're becoming this one-stop shop for all these different aspects of the American healthcare system. Certainly the geopolitical risk is something you want to be evaluating here. And then the massive amount of leverage here, because management to me has shown poor prioritization as far as what they're deploying their dollars for. They're making acquisitions. They're taking on debt still when it's like in a very expensive environment, rather than choosing to pay that down at the expense of reducing their dividend, which is something I would prioritize personally. But yeah, there's a lot of questions still to be answered here. I know Burry has bought it and sold it multiple times, so it's more of a swing trade for him than it is anything else. But as a long-term hold, I'm not there yet. I would need to do more evaluation of this before I would even consider whether or not it belongs in my portfolio long-term.
So, a couple thoughts. One, the Walgreens current ratio is 0.65.
Perfect.
So, not ideal. One, in no way, shape, or form is Walgreens and CVS going bankrupt. We just don't have the infrastructure. I guess I can't say that 100%. 99.99% chance both of them don't go bankrupt.
Yeah.
There's just too many people that rely on healthcare and medications. It's just not really an option.
No.
On top of that, the free cash flow is pretty solid. Can you go back to the chart? So
Yeah.
I wanted to like this more. There's just too many better opportunities in the market. Now, there is two comments I have. One, I do think that this is a pretty interesting swing trade. Now, this is not an interactive chart, so I can't look at the exact numbers, but you can see there's clearly a level around 51 that we got close to hitting but haven't hit. So when that hits, I may do a call option. And then I love these trades because you can just do a super short stop loss. The risk of losing is way higher than winning, but the amount that you lose is not that much at all because you just set a stop loss below 50, and then if it happens, it happens. So it's usually a pretty short Michael Burry-esque trade that you just leverage calls. I do that on these all the time. Now there could be a recession coming, and that would kill this. And it wouldn't kill it. That would bring this down pretty hefty. I think it would. You don't think it would?
No, it's more consumer staples than anything else at this point. These aren't discretionary purchases. They're not selling Louis Vuitton handbags here, right? They're selling
true
medications you need to stay alive and access to primary care.
Well, this is America. People care more about Gucci handbags but yeah. I think if this hits 40, this is significantly more attractive. But it's just too high for what you just said. That's a bummer. Damn it.
Yeah. It's one I'm going to keep my eye on, though, and I'm going to listen to their next quarter conference call and pay a little bit more attention to. It's a little bit more on my radar now than it was before. Put it that way.
The debt's huge. That's crazy. Way too much debt.
I want to hear from management themselves as far as long-term plan and capital allocation plan. I want to hear how they spin it, how they sell it. That's what I want to know.
All right, guys. Let us know what you think. If it deserves a spot in your portfolio.
Yep. Goodbye. Catch you in the next one.